Now, Wells Fargo got itself into trouble last year when it was found that it was illegally opening as many as 2 million deposit and credit card accounts without the knowledge of the customer. Now, it was fined. It was found out, and it was fined about $185 million. And there are a lot of people who were working there that ended up being fired from the positions. These are a lot of the people, the lower people on the floor in middle management. So they were purged like, oh, you guys, I can't believe that you would do this terrible thing, opening these accounts and then charging interest and then whatever, making money, like however way they made money off the scheme of illegally opening these accounts. They got rid of these people, kept all the profit, except for that $185 million, which I'm assuming didn't really put a huge dent since Wells Fargo was an enormous bank making hundreds of millions, possibly billions of dollars in profit. So now there is new information out on another thing that Wells Fargo had done to screw over its customers in pursuit of profit. Now, this is from ProPublica. Now, they are reporting that 4 different Wells Fargo employees in the LA region, and this is the LA region only, I have to stress that, they say the bank regularly charged customers improperly in order to extend their promised interest rate when their mortgage paperwork was delayed. Now, I'll do a breakdown of what this actually means later on. But basically, what they did is that they, for people who are trying to get a mortgage, they charge you an interest rate on that loan. And they say, you can lock in this loan if you get your paperwork now. Oh, look at that. Your paperwork's late, but if you still want to lock in this loan, we are going to charge you an extra fee. So that's kind of the gist of it, right? If you want to keep your low interest rate, you got to give us some money because your paperwork, it's your fault you sent in your paperwork late. That's essentially what they're saying. Now, the employees that had worked there, the former employees, said the delays were actually usually the bank's fault, but that management instead forced them to blame the customers so they can get that money from the fees. Now, one of those employees thinks that this is even worse than what Wells Fargo had been recently fined for. Now, this is a Wells Fargo former Wells Fargo loan officer named Frank Chavez. Now, he wrote this in a letter that was recently released back in November to Congress. Now, he says, I believe the damage done to Wells Fargo mortgage customers in this case is much, much more egregious than the sham accounts. We're talking about millions of dollars just in the LA area alone, which were wrongly paid by borrowers' customers instead of Wells Fargo. Now, Chavez had worked there for about 10 years. And he had just recently resigned from his job in the Beverly Hills Private Mortgage Group back in April. Now, Chavez sent his letter to the Senate Banking Committee and the House Financial Services back in November and never seemed to have gotten a reply. That's kind of weird. I wonder if Congress is owned by the banks. I wonder. Now, there are also 3 other employees that I mentioned, former employees of Wells Fargo in the LA area that confirmed Chavez's account. Now, they say that the man that's in charge of the region, the LA region, a man named Tom Swanson, was responsible for this policy. Now, so how far did it go? Well, I mentioned earlier that this was only in the LA area as far as we know. According to 2 of the former employees, other Wells Fargo employees from different regions told them that the bank did not charge extension fees for customers as a matter of routine, unlike what they did in LA. Now, 3 of the former employees who now work for other banks say that their new employers also do not engage in these practices. So this is essentially LA region and LA region alone, which, look, is a incredibly big region. There's a lot of money in that area, especially when you look at the housing prices and how much money people have to take out for these loans. Now, in case you're wondering, as I said, how this works, I'm going to give you a little bit of a breakdown. Basically what happens, and this is standard throughout most of the banks, a loan officer will start a loan application for a client. Now, in order to do that, you got to get some documents, tax returns, bank statements, all that stuff, right? As well as getting the title to the property. Then, of course, the loan officer prepares a credit memo, submits the file to the processing department, and underwriting for review, fairly standard stuff. Now, that process should take no more than 60 to 90 days. depending on what kind of loan you get. Okay. Now, during that period, the bank will allow a customer to lock in the quoted interest rate on the mortgage, which is generally pretty low. Now, when they lock in this rate, it basically prevents them from rising interest rates. However, if they miss that deadline in filing their paperwork and the rates have gone up, the borrower, well, first of all, if they don't want to pay this higher interest rate, they can do something, they can essentially extend this low rate for a fee, typically about $1,000 to $1,500, depending on how big the loan is. So that's what we have. Now, Wells Fargo policy is to pay extension fees when it's at fault for its own delays. However, in the Los Angeles region, the former employees say Wells Fargo made customers pay for its failures to meet those deadlines. Now, these former employees attribute those delays to inexperience and low pay in the processing and underwriting staff. In addition, in order to cut costs, the bank, of course, understaffed their offices. So they don't have enough people, and the people that are there are untrained. They're not trained as well. And they're not good at their jobs, essentially. And I'm not like casting shade on those people, but if you're poorly trained and you're poorly paid, if you're a guy off the street, yeah, you're not going to know how to underwrite a loan. You're not going to do it very fast. So there you go. Now, according to the former Wells Fargo employee, the reason that we are not closing on time was predominantly lender related. When a loan officer asked the bank to pick up the extension fee, it didn't make a difference if the written request was a one-liner or the next War and Peace. The answer was always the same. No, declined, borrower paid, never, lender paid. Okay. Now, anticipating that it couldn't close on time, the bank decided to come up with some different strategies in order to shift the blame to customers. That's not our fault, it's your fault. Okay. Well, the most blatant methods of attempting to transfer blame onto customers, Chavez wrote, included having loan processors flag the file for missing customer documentation or information that had already been provided to the borrower. The customers would then have to refile, blowing past that deadline. So look, anybody who's ever had to fill out any kind of paperwork knows how frustrating it is to gather all those materials together. You gotta get all the records and you gotta fill out the paperwork. It takes a while and it's annoying. And knowing that this particular bank region was making you do all that bull crap on purpose, oh man. Like, you guys don't know how much I hate paperwork. I despise paperwork. I hate it. I hate doing it. So knowing that right there, oh, that would make my blood boil. Oh, it would piss me off so much. And look, it pissed off a lot of people. In fact, there are a lot of people who decided once they started charging these fees for lost paperwork or missing paperwork or getting them to refile, they're like, screw you, we're going to go to another bank. Okay. Now, not only that, but sometimes loan officers would ask customers to submit extra documents that they didn't actually need for its initial assessments, burdening them with even more ridiculous paperwork to ensure that they did not meet this deadline. On occasion, employees reportedly built in a cushion, quoting a higher fee at the beginning. That way, they didn't have to go back to tell the customer about the extra fee at the end. So, look, that's kind of dirty, right? Immediately dirty and frustrating as hell. And obviously, the company itself, at least in that area, the regional manager didn't do anything to discourage it. In fact, they encouraged it. One employee said he complained to the boss about the situation, but upper management referred the problem back to the regional manager. The employee's immediate manager then decided to scold him. Now, they also told the manager also told coworkers that he personally took a hit if the bank paid out too many extension fees. He says there would be very upfront that their bonuses are tied to extension fees. The other former loan officer says during a meeting, the branch was told extension were costing the branch money. Now, look, I know that if you tie fees like that to somebody's bonus, like a regional manager's bonus, well, that manager is going to make sure that everybody has to get those fees so that he can put them in his pocket. Now, it's not the first time this guy has gotten in trouble for trying to make money by screwing over customers. This guy's last name is Swanson, of course. What was his full name? It's Tom Swanson. Now, in 2005, customers in Los Angeles sued Wells Fargo for racial discrimination. Now, they contend that Swanson prohibited loan officers in minority neighborhoods from using a software program that gave them the ability to offer borrowers discounted fees. He allowed loan officers to use that same program in white neighborhoods, where residents paid lower fees as a result. Believing that minority borrowers did not shop around for mortgages, Swanson contended that Wells Fargo did not need to offer those discounts in their neighborhood since they faced less competition, according to witnesses' testimony at this trial. And in 2011, an LA Superior Court jury found that Wells Fargo intentionally discriminated on a portion of the loans in question and awarded plaintiffs a total of $3.5 million, a decision that was upheld on appeal. And with interest, the payout rose to just under $6 million. Wow. Now, if you ask the bank, well, they said, oh, we didn't settle because they were right. We settled just to settle. We didn't want to have to appeal anymore. It's too annoying. They said, the spokesperson for the bank said, the verdict in the case was not in line with the law and the facts, and there was no evidence that class members paid a higher price than other similarly situated borrowers. Nevertheless, the bank decided to pay the judgment rather than pursue additional appeals. And the thing is, this Tom Swanson guy, he's still there. He's still working there after all that. Barry Capello, the plaintiff's attorney in the case, referring to the region Swanson oversees, says, quote, Swanson runs that place. He is the man. They do what he wants done. Despite the lawsuit and the millions they paid out, the guy is still there. Jesus. Now, look, here's the thing, right? Some of you might think, yeah, but okay, maybe it's not this guy's fault. Maybe it's not with ill intent. Maybe it's just poor customer service, and it's not criminal. And you're right, it isn't criminal, but I don't think it's just a result of poor customer service. I think it's cost-saving measures run amok, and a toxic corporate culture that encourages screwing over the customers. Now, what they need to do is they need to properly staff their departments. And if it's their fault, admit it and then pay the fee. What this is another example of a company trying to shift their mistakes and losses onto you, the customer. This is the thing that we're trying to get away from. Now, how much did it cost a lot of these borrowers, right? These people that end up having to pay these fees? Well, there's a few estimates, and the overall amount is generally unclear. But Chavez and another employee estimate that they ran into the millions of dollars. And another former employee estimates that a quarter of the mortgages at the branch had to be extended. And by that measure, if a loan officer did $100 million of loans in a year, those mortgages would get about $62,000 in extension fees, right? Now, take that in context when I give you the next number. The Beverly Hills office alone, one of 19 other branches, did around $800 million to $1 billion in underlying mortgages. That generated about at least $500,000 in extension fees that came from your pocket right into theirs. Now, it may not be criminal, but it is grotesque. So how do you fight against it? Like anything, if you're going to get a loan, be careful. Do your research, do your homework, be careful, read the terms so that you make sure that these banks don't end up screwing you over.